Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp, and it's great to have you with us this morning. So if you like to get on your favorite news site at 8:30 in the morning to check the employment numbers, you might have had to scroll down a little further than usual today. There seems to be some sort of disagreement between important parties in Washington, D.C. that is taking up a lot of news space. We're not going to talk a lot about that today, although it's possible you will hear something from our chief economist, Gerald Cohen, who's going to be on with us in a moment to talk about the jobs numbers, policy making out of Washington, how quickly things come out, but then how slowly things develop sometimes and how some patience is required, and perhaps a little bit about that aforementioned disagreement between parties. So anyway, thanks for being with us this morning. We appreciate it. After Dr. Cohen comes on and gives his presentation, we'll have time for questions from you all. You can ask those at any time during the briefing by using the Q&A function at the bottom of your screen. If you are with the media, please remember to include your organization so we can prioritize your questions. If you're with us by phone today, you can also ask a question. You can do that by emailing me at rob_knapp@kenan-flagler.unc.edu. As always, we're going to try to wind this up about 9:30. We might go a little bit longer. We'll see what happens, but we'll get things launched right now. We welcome back our chief economist, Gerald Cohen, to talk about what's going on in Washington these days. Gerald, good morning, and how are you doing?
I'm great, Rob. How are you this morning?
Terrific, thank you.
So yes, this is going to be a generally econ safe space. What I will say is that if you think from a dollars and cents standpoint, the kind of yesterday's kerfuffle seemed to be a very negative ROI for Trump, for Musk. If you think that he spent $250 million to help Trump, and the value of his holdings went down uh, uh, by hundreds of billions of dollars. So so I'm not sure the ROI is that good on that investment, but not saying it was necessarily investment. So if I were to go turning to the econ data, let me just start my presentation or share my presentation, and we can go from there. There we go. And so if I were to call, I just want to make sure that that is, yeah, there we go. If I were to kind of call, if I were to, my first reaction to this report would be, this is effectively what a soft landing would look like. And in particular, if we look at the jobs numbers, we've kind of settled in around 125, 140-ish thousand jobs per month. That's a slowdown. We have, given population dynamics, we can't really, and current immigration status, we're not creating that many new people entering the labor force. And so, we kind of needed a slowdown. And what you want when you want a soft landing is that the labor market slows enough, but it doesn't keep slowing. And that's the risk. Generally, soft landings are few and far between. So the fact that we, for the last 5 months, kind of slowed but not continued to slow is a really good sign for the economy. And if I just stopped there and said there's no policy going, no craziness in policy, no risks on inflation, I'd say, okay, this is great. Let's call it a day and open it up to questions. The challenge is that there are lots of risks out there, and I'm going to talk about that momentarily. I also will note, and and um, and this is something that's really important. There's a lot of complaining about revisions to the data. It shows how bad our data is. The fact is that revisions actually are a sign of that we are trying to get it right. Remember, these surveys are done, in the middle of May. 3 weeks later, they're releasing a number for, they're surveying 600,000 firm sites or 600,000 plus firms, site job sites. They're tallying those numbers. The response rates go up over time, so people may not have, sent that email or or responded to that email, or I don't think they're still faxing numbers in, but or gone to that website in enough time, and so by the next month, response rates are over 90%, and so you're going to see revisions. And that's true. And then, a year later, as we get the unemployment insurance data and we get the tax data, we're going to see more revisions. And then, so the fact that we revise the data is a positive sign. And so the fact that we had net negative revisions of 95,000 in the previous months, to me, is a net. The revisions is a positive sign about our data quality. The negative revisions is a worrying sign because maybe this 139,000 will become a number sub 100. And so maybe this trend that we're seeing is less clear. So that's a worrying sign to me. But again, on the face of it, a very benign soft landing report. Couple of things to note. The federal government has shed about 59,000 jobs. So, we're getting more growth from the private sector. Job creation, the private sector is running about a bit higher. You've had offsets from state and local governments, but you have this drag from the federal government, and it's going to get worse in September when all those deferred resignations, retirements come into play. So we're likely to continue to see and maybe a big slug of numbers in the September or maybe October report, because I think the September the resignations end, as of September 30th. So you'll see that in the October data. So that's something to look out for. The flip side is, and we continue to get strong. The two areas of strength are education and health, in particular health, and leisure and hospitality. So we're running a bit, again, a worrying sign is we're running a bit on these two cylinders, education, health, and leisure and hospitality. And you're hearing about some concerns about people going to restaurants, things like that. Unemployment rate unchanged at 4.2%. A little bit of the household numbers had some, kind of a little bit more weakness, but I generally focus on the payroll numbers. But kind of offsetting, you had a bit of an increase in the unemployment rate, a bit of decline in the unemployment level, a bit of decline in the labor force, kind of offsetting this unemployment rate was unchanged. Labor force participation declined in the month. You saw a decline in both prime age and 55 plus. Prime age, are 25 to 54, as it's called, and 55 plus involvement. But nothing particularly notable about that data. The only thing is, or nothing particularly notable, I was going to say, the female participation was unchanged of prime. It was male and 55 plus that were driving that. And hourly earnings rose a healthy 0.4%, or up 3.9% year on year. That's given the kind of current inflation dynamics, that means that inflation-adjusted wages are kind of unchanged in a positive territory, a nice positive territory that supports spending power. The question is are we going to see reversals in the inflation numbers as a result of tariffs? And my answer is yes. And we're seeing some signs in the in the outside of the headline data. The hours worked were up 1.3%. If you take hours and productivity, you take hours worked, or they're running at a 1.3% rate in Q2. If you take hours worked and productivity and add an assumption for productivity, you're going to get GDP. So GDP was down in the quarter. Hours were up in the first quarter. Hours were up, and so you had this big negative productivity number. Will that reverse in Q2? At least on the hour side, you're seeing positive growth, likely to see some rebound in productivity. The Q1 numbers were kind of funny. because of the impact of tariffs and things like that. My bet is that ultimately, talking about revisions, they'll be revised to a positive number, so productivity won't look so bad in Q1. But that's it's betting on revisions is kind of a weird thing to do. Turning to policy. So I think there's a question that we should all be asking about the policy mix. What are tariffs meant to do? Are they meant to create jobs or create revenue or generate revenue? Because you really can't do both. Um, if you're generating a lot of revenue, that means if you're meant to generate a lot of revenue and the CBO is saying that it's going to generate over the next 10 years 2.4 trillion or 2.6 trillion or 2.4 or 2.6, depending on the you see the if you see the economic impacts of these, then that means that we're still importing, and that means that we're not substituting jobs for imports. Or if you're not generating revenue, if you're actually seeing that substitution, then what's going to happen is you're going to actually revenue, revenue from tariffs is going to go down. So I think that's an important question. The administration talks like you can do both. You can't, because again, if you're seeing job creation, if you're seeing an offset, an impact of tariffs on people's decisions or firms' decisions on where to produce, and you see an increase in production in the U.S., that's going to lower tariff revenues. Also related, and so this question of how many jobs are going to be created by tariffs, nobody's talking about that. Nobody's on the policy sphere, nobody's answered that. They've also been talking about how deindustrialized the US is, and I just want to point out in this chart that manufacturing output has grown by 6.6x. So it's up almost sevenfold from where it was in 1950 when people talk about the heyday of manufacturing. The number of employment is down about a little less than 10%, about 9%. So we have 12.8 million jobs. So if you say we've lost manufacturing jobs, yes, that's true. But have we lost manufacturing output? No, overall output on an inflation-adjusted basis is substantially higher, and that's because of productivity. So we're saying, okay, we have 12.8 million jobs. How many jobs are we going to create? And where are they going to come from? If we're at full employment at 4.2%, who's going to take those jobs? What sector is going to shed jobs to create manufacturing jobs? Are there really people that are sitting there waiting for that manufacturing job to come? These are questions that I think need to be answered when you're talking about this policy. And then the question is, okay, so tariffs may be generating income, and so that is a fiscal drag because, as we are seeing, and I'll talk about this, it's most of the tariffs are being passed on to American consumers. So that's a fiscal drag. Now you might get fiscal stimulus from the big, beautiful bill. And again, questions that we need to ask. So this chart shows the revenues as a share of GDP, the orange line, outlays spending as a share of GDP, the blue line. The question is, the red line has basically been flat. And if assumes that the 2017 tax cuts will expire, assumes that they will expire. If they don't, that red line after 2025 is going to go down. And so the big, beautiful bill cuts the blue line a little bit, but the red line a lot. So the total the total deficit increase from the big, beautiful bill is about $2.4 trillion estimated by the CBO. Tariffs could offset that if they hold, but have a negative impact on the economy, or won't happen if we create all these jobs. But one of the questions that I think people need to be asking from a policy standpoint is, why are we so focused only on spending? What about the revenue side? And the spending side, people are saying, oh, spending's gone up. Most of that is because of demographics. We're older, people are retiring, Social Security, the big things are Social Security and Medicare. And both of those have more to do with demographics than a huge increase in programs. And so unless we want to talk about cutting those programs, we need to talk about raising more revenue. And I just don't understand why that discussion isn't in the policy mix. Like, if Americans want a safe social safety net, we need to pay for it. And so that is really worrying to me. Going to the policy and kind of the fast and slow, I want to give a shout out to Rudy Dornbush, who was my inspiration to go into economics. And actually, he and Stan Fisher, who unfortunately just passed away, who I was fortunate to have studied at the FEED at, um, wrote, in economics, things take longer to happen than you think they will, and then they happen faster than you thought they could. So I think that's, in some respects, the theme of this talk. We are worried about the impacts of policies, but we're not seeing them. And maybe we will never see them. And that's where kind of the long and variable lags of policy happen. If you look at this chart, you'll see that Fed raises rates, and usually they're cutting rates by the time we're seeing a recession because they've overdone it. But it takes time to see that. To Rudy, it takes longer to happen than you think. And then suddenly things happen faster. You start this recession and kind of things get worse. Rudy was talking in particular about emerging markets, but it's true in the United States. So when you think about the impact of policy, you have to incorporate those long and variable lags, and we just don't know. Um, but we are looking at data. And so we can see high frequency data like layoff announcements. So here you can see layoff announcements. They jump to recessionary levels. They've come back down. And so there have been a time in the early 90s when they jumped to this level and you didn't see a recession. And then there are other times when they jumped and you have seen a recession. So the question is, will these layoff announcements become job cuts? At the moment, not seeing it. Are we seeing a little bit in the high frequency data of jobless claims? You're starting to see a pickup, but and there's a lot of wiggles and waggles on a weekly basis. So look at that 4-week moving average, the orange line. And so that is picking up, but it's still at very low levels. So that's something that we're watching really carefully. Consumer expectations. I heard somebody on CNBC say, or one of the programs, sorry, saying expectations are really strong. They're not. Or consumer confidence is really high. It's not. So first of all, a data check on that. Another data check, by the way, I heard is there was a podcast where people are saying we're not going to be able to see the fiscal impact of tariffs. This was from a bunch of investors that are supposed to know these things. I just showed you, well, I can show you data. Every day, the Treasury releases data that shows how much tariffs. And so we can see on a day-to-day basis the revenue brought in by tariffs. But consumer expectations are falling. Will it turn into spending cuts? We're seeing some signs. You saw this big increase, front loading in good spending, the blue bars. Service spending looks fine. You saw a decline in the month of April, but it's 1 month. The data is really volatile, so something that you need to keep an eye out on. In addition, will flagging business confidence weigh on capital spending? And this chart illustrates the addition to GDP from 3 sectors of CapEx: tech equipment purchases, software purchases, and R&D. In the first quarter, despite the negative print, they grew at a 1.2. They added 1.2 percentage points, or over 1.2 percentage points, to GDP growth. That is quite strong. Then if you kind of go back and look at the 1990s level, that is on par with the kind of heyday of investment and productivity that we saw, or heyday meaning, or this period of high productivity that I've talked about in the past that we saw in the mid 1990s to mid 2000s. So that's a positive sign, but will concerns about investment, concerns about the economy weigh on this? This is the key driver of CapEx. By the way, it's over 50% of capital spending are these three sectors: tech, equipment, software, and R&D. So it's over 50%. So watch this really carefully. It's hard to see in real time other than corporate announcements, but something that we have to see, we're watching quite carefully. And then talking about the impact of tariffs on inflation, yesterday, or the New York Fed released this survey of local firms. So I want to stress that this is only firms in the New York, New Jersey area that the New York Fed covers. Yes, that as we illustrate in our extended metro, our AGP framework, that's about 10% of the U.S. economy. But we are seeing that the vast majority of local firms, or New York, New Jersey firms, are passing those tariffs onto inflation. And so we're watching that data carefully. In particular, you're going to see most of it in the goods sector. And notice how in the kind of low inflation period of the 2010s, and even since 2000, you've seen service sector inflation growing 2 to 3%, and goods inflation declining, so offsetting that. So we had 2% and sub 2% inflation because goods prices were falling, service prices were rising a bit above 2%, and they offset to roughly 2. Now you're seeing a pickup in goods prices. So again, something to watch. I also want to put in a big plug for worrying about the quality of this data. There's been a number of reports, cuts in governments, into the BLS. They're not getting the number. There aren't enough people out there that are measuring this data. They actually send people shopping, and you're seeing cuts in that, and so you're seeing an increase in imputation of this data, which means that the quality is going down. It's less clear what the signal is, and so that's worrying not just for the CPI, but for the all of the data that we're looking at, that we looked at this today. So let me stop there and open it up to questions.
Sorry about that, Gerald. You caught me
No
punching
problem.
buttons, caught me punching buttons on here, and I'm back now. Thank you very much for that analysis. It seems like there are a lot of things to consider and a lot of indices to continue to watch in the future to see where things might be going. We had a request, and I'm sorry you just took your may just take your presentation down, but if it's still up, can you go back to the first slide? Somebody asked to see the first slide again. And I'm
This
suspect,
slide or
yeah,
this slide?
I think it's that one.
This one.
Um,
The slide where you're looking at
well,
at at national employment, or the first slide that as
show
in
us that one first, because
okay.
I suspect the request might have come because we didn't have it up for very long before we started the briefing, and people may get
Okay.
used to seeing those numbers for a little while before we come on. So, for the person who had that question, I thought we would give them another look at that. And now, if you could just pop to the one after that.
Sure.
Um,
So I'll point out this illustrates this, upward, data was a bit stronger than expected. By the way, the ADP came out with a much weaker number. I'm suspect of their numbers. I've done research on this. As much as I like them, it just illustrates how the administrative data is much broader. Um, but this illustrates the downward revision. So kind of somewhat positive, but also downward revisions.
and also for the last, I think, 3 months, these numbers have been in a fairly tight band, haven't they?
And that's what this second chart illustrates, that
Yeah.
we've really seen this, you are kind of in and around 100, the 3 month, in and around the 3 month average is basically 140, 38,000. So we're right, that's what this orange line says. And it's not because it's wiggling and because of large, ups and downs. We've basically been in this very solid, healthy, this is the soft landing story.
Right. Right. Okay, very good. Chris, I hope we gave you what you needed there. So thank you for checking in with us on that. Let me go to a couple of other questions now. This one says, what do you attribute to the divergence in Consumer Board and Michigan consumer expectations data? Is it common to see one rebound and one continue to sink? Is it inflation related?
So very good question, and a little shout out to a shout out to my colleague Cami Cunin, who's an expert on consumer expectations, and we have a happy economist that was recently released on that, and that links linked on LinkedIn on our Happy Economist channel, and also there's a link to it on our to it in there, and also if you go to our Kenan Institute website that talks about the differences. And you'll actually get here. You're gonna go to a bonus slide. So this is the two different confidence measures. Um, and you're both seeing not great numbers. And again, one of the points is that confidence can decline, and as we saw here, and you don't see a big impact on the economy, or you don't, so you can have confidence declining or confidence rising, and the impact on the economy can be muted. This is a case where we see a huge divergence, and that divergence is a result of different focus of the surveys. So the Conference Board asks a lot of questions about job creation, and so it's kind of focused on that. And we noted this month 139,000 jobs. Job creation is kind of running at the steady 140,000. It all looks good. The sentiment number focuses more on inflation, and their data is showing people are very worried about inflation. And the Fed is saying, "Oh, that data that's worrying because people are worried about inflation. They're going to start acting like higher inflation. And if you act like if people act like there's higher inflation and firms start to raise prices in expectation, then you get this kind of vicious cycle." So that's been driving. So inflation seems to be driving the gap between these two measures. The the expectations number is not as wide as you can see, but there has been this rebound, and I think in some respects this rebound is more on the Conference Board measure, which again, it's more people were worried. It's kind of the flip side of this, where you saw a bunch of layoff announcements, and then it was like, okay, job market's okay. We continue to see that.
Okay, very good. Let's see. Here's another question for you. Should we be concerned that most of the job growth is coming from sectors that tend to be non-cyclical, like healthcare?
So yes, in some respects, the healthcare side is, if you say to me, what's going to be the biggest job creator in the economy, over the next 20 years, it's likely to be healthcare, kind of consistently because, and this goes to the budget question, we have an older population that is increasing demand for healthcare, and so that is a sector that's kind of structurally growing. That doesn't mean, and I'll say my daughter just graduated from nursing school, so shout out to her, and she's kind of she's deciding which job she wants to take. But that doesn't mean that there isn't potential cyclicality. And I'll say, and based on some of her experiences, that there are especially university affiliated hospitals are saying, well, wait a second, our funding is in question. So there are cyclical risks, but structurally it's a strong area of growth. So would I like to see leisure and hospitality much more cyclical? Some of it is there was this shortage, and so businesses are making up for it. That one I worry a lot more about. But what you can see is you can actually continue, and I'll have to show a chart next time of healthcare jobs. You can see a continued job creation in healthcare and losses everywhere else, and that's recessions aren't made because every sector declines. It's because some sectors can decline, and actually that's illustrated in some respects by this chart, right? We had tech investment fall very little, but overall investment fell a lot in this recession. And so that can be so you don't need to see So you can still have jobs that are structurally growing with cyclicality.
Okay, very good. Thank you. We've probably got time for one more. This one is from our friend Barbara Senich. What do these data in aggregate suggest for the interest rates going forward?
Um, I think this data suggests that the Fed is unlikely to be cutting rates so quickly. Like if you've got this kind of what looks like a soft landing, but you might have inflationary pressures out there. So that soft landing may say, okay, well, we tightened enough, we may be able to move a little bit, but I wouldn't expect a lot, and especially or a lot of cuts, and I might even say no cuts, but I won't. I'll say I don't want to say never, but I'll say I wouldn't expect a lot of cuts at this moment, especially given the inflation risks. And the Fed just, well, we'll look at the data. The Fed just won the inflation battle, or not, or I don't want to say won, just fought and kind of lost an inflation battle because they expected inflation to come down sooner. People are kind of saying they didn't do a good enough job. By the way, hindsight is 2020. Um, but given the what happened, recent history in inflation and the Fed's kind of, I'll say, so I won't, just going back on the word one, given their flub on inflation, they are unlikely to cut rates a lot, given what is likely to be out there on the inflation front.
Okay. All right. One more quick one. Sorry. Lightning round. Are there any interesting gaps between the trends in household employment versus payroll employment?
There are actually. So this is, I kind of mentioned this earlier, and so let me kind of give a, if I can do a quick lightning round. So there are two surveys.
Hmm.
There's a survey of job sites, the payroll numbers, how many people are on payrolls. There's a survey of households, how many they actually go and talk to people in their home, not at their in the job site. They're asking firms, how many people have you hired or fired? And in the, or what's your net payroll look like? And then they get to the hiring and firing later. And then they ask people, do you have a job individually? Like they call people, they text people, they actually walk into people's home, yeah, they knock on doors. And those are two different surveys, and they can give disparate results. The problem, the household survey is smaller. It's around 60,000 households. And actually, because of funding, there have been potential cuts to that. Um, at the, but, and so it tends to be much more volatile. And you saw that this month. 139,000 jobs were created in the payroll survey. 554,000 jobs, don't quote me on that because I'm doing the math on the fly, were lost in the household survey. Over 500,000 jobs were lost in the household survey. Normally, there's enough volatility that I don't worry about that. But one of the things that I found, and this person that's asking kind of knows me enough well enough to know that I say this, that I found in the past that the payroll survey during turning points can be problematic because they have to impute job losses for firms. Like they'll call up a firm, and if the firm doesn't answer, they don't say they're out of business yet. And so you'll only know in the future if a firm has gone out of business or if a new firm is not starting. And so that household survey can be accurate during turning points. I'm going to discount it at the moment. It's volatile, but it is a worrying sign.
All right, then I think we'll end it there. Thank you very much, Gerald Cohen, for covering a lot of ground in 30 minutes, as always, maybe a little more than usual this time. So we appreciate it very much. The briefings are very busy these days. We thank all of you for being with us and thank you for your questions. We always enjoy getting those and taking a chance at answering those. So thank you. To all the members of the media that are with us, we hope that you might be interested in talking to our experts more about this, including Dr. Cohen. If you do, please reach out to me at rob_knapp at Kenan-Flagler.unc.edu. for everybody out there, we have a lot of new things on our website put up in the last week or two. So lots of new things to find there. We encourage you to go to kenaninstitute.unc.edu and please take a look at them. Going forward, in July, we're going to throw you a curveball. I believe July 4th is on a Friday, which means the jobs numbers, according to what I saw, are coming out on a Thursday. So we will be here on Thursday too, Thursday, July 3rd. Look for registration information to come out for that briefing soon on our website. And if you are on our email list, you will get an email ahead of that as well. So thanks again for being with us. We appreciate it very much and enjoy your Friday.
Thanks, everybody. And thanks to the team that Cody Morris, Corey Powell, who kind of worked behind the scenes to make this all happen.